So basically in this question we have assets also. Then we have additional information like goodwill is revalued at rupees 2,50,000 while plant and machinery is expected to realize rupees 2,85,000. Then we have a debtors are subject to the provision for bad debts at 7%. Then we need to calculate the value of share on the net asset basis. So first of all, first step is to calculate the net asset. Net asset is equal to realizable value of asset minus outside liability. What are our realizable value? First one is goodwill for 2,50,000, then plant and machinery that will cost 2,85,000, then furniture 50,000, investment 4,40,000, stock 1,80,000, debtors which we need to take 1,20,000 minus 7% of 1,20,000 given in the additional information. These are the bad debts. Then we deduct from the debtors. So the value is 1,11,600. Then we have a bank balance of 50,000. Then we deduct 12% debentures for rupees 4 lakh, creditors for 44,000, provision for taxation 50,000, employee provident fund 1 lakh 5,000. Then we have a net assets of the value of 7 lakh 67,600. Then we have a step 2, that one is known as calculation of valuation of shares. So value of share is equal to net asset divided by number of equity shares. So that will be 7,67,600 divided by 25,000. So we have rupees 30.704. That is the value of a particular share, of a single share. Again, we have an illustration. First of all, we have the equity and liability. Then we have assets. Then its total. So the fixed assets are valued at rupees 16,20,000 for the purpose of valuation of shares. Goodwill shall be taken at 2 times the average annual profit of the last 3 years, which were 3 lakh, 6 lakh, and 7 lakh. Interest on debenture is outstanding for 6 months. There is a liability of rupees 24,000 not recorded in the books. Find out the value per share on the basis of net asset method. So in this we have weights actually. So according to the solution, first of all we need to calculate goodwill which is included in net asset. So we have 3 years, first, second, third. We have profits like 3 lakhs, 6 lakhs and 7 lakh. Then we have weights 1, 2, 3. Then total weight is 6. Product of a profit and weight is equal to 3 lakh, 12 lakh, 21 lakh. So the total of the product is 36 lakh. So the weighted average profit is equal to total product divided by total weights. That will be 36 lakh divided by 6 is equal to 6 lakh. Then goodwill is equal to 6 lakh multiplied by 2 is equal to 12 lakh. So we have a step 2, calculation of net asset. So in the calculation of net asset is equal to realizable value of asset minus outside liability. So we have goodwill of rupees 12 lakh, fixed asset 16 lakh 20,000, current asset 2 lakh 40,000. Then we deduct 8% debentures 4 lakh, deduct current liabilities 20,000, deduct unrecorded liability 24,000, deduct outstanding debenture interest 6 months 16,000, and then we have the net asset 26 lakh. Then in the step 3 we have distribution of net asset between different equity shareholder ratio of equity shares. So 6 lakh ratio 4 lakh and 2 lakh ratio 1 lakh. So the ratio will be 6, 4 to 1. So the 30,000 equity share will get net asset is equal to 26 lakh multiplied by 6 divided by 13. So it will be 12 lakh 25,000 equity share will get net asset is equal to 26 lakh multiplied by 4 divided by 13 is equal to 8 lakh. Then we have a 20,000 equity share will get net asset is equal to 26 lakh multiplied by 2 divided by 13. Then we have 4 lakh. Then 12,500 equity share will get net asset is equal to 26 lakh multiplied by 1 divided by 13 is equal to 2 lakh. So, our fourth step will be calculation of net value of shares. So, the value of share is equal to share is equal to 12 lakh divided by 30,000 is equal to rupees 40. Then the value of rupees 16 paid up share is equal to 8 lakh divided by 25,000 is equal to 32. Then value of rupees 10 paid up share is equal to 4 lakh divided by 20,000 is equal to rupees 20. Then value of rupees 8 paid up share is equal to 2 lakh divided by 12,500 is equal to 16. Then there is a dividend yield method. So in this method, there is one of the main limitation of the net asset method is that it can be used at the time of liquidation only. But the shareholders are always interested in knowing the value of shares in terms of the return on the investment. He compares his return with the price paid by him for the share. So, therefore, under this method, the value of share is calculated by comparing the expected rate of dividend with the normal rate of dividend, which is prevailing in the industry. So, following formula is used for valuing the shares under this method. So, value of share is equal to expected rate of dividend divided by normal rate of dividend multiplied by paid up value per share. So, the calculation of expected rate of dividend that will for that calculation of the expected rate of dividend, the profit available for equity shareholder is calculated as follows. First one is profit for the of the company. We need to take, then we deduct income tax, then we deduct transfer of reserve, then we deduct transfer of debenture sinking fund, then we deduct preference dividend, then we have the amount of equity shareholder. So this amount available for equity shareholder is divided by the paid up equity capital for the calculation of expected rate of dividend. So the expected rate of dividend is equal to profit available for equity shareholders, then we divide paid up equity share capitals multiplied by 100. So the calculation of normal rate of dividend, so the normal rate of dividend is normally given in the question. This rate is different in different industry. Higher the risk in the business, higher will be the normal rate of dividend. So in the illustration which we have, we need to calculate the dividend yield method. So first of all, we will take issued equity share capital, that will be 20,000 share of rupees 10 each. Then paid up equity capital rupees 8 per share. 6% preference share capital, 2 lakh shares of rupees 10 each fully paid up. Then annual transfer to general reserve 20%, rate of tax 50%, expected profits before tax 4 lakh, normal rate of dividend 15%. Here we have a solution. Step 1 is calculation of profit available for equity shareholders. First of all, we have expected profit before tax, that will be 4 lakh. Then we deduct tax at the rate of 50%, 2 lakh. Then we have profit after tax, 2 lakh. Then we deduct transfer to general reserve at 20% of 2 lakh, that will be 40,000. And we get the profit available for shareholder, that will be 1,60,000. Then we deduct preference dividend 6% on 20 lakh, that will be 1 lakh 20,000. And in the end, we have profit available for equity shareholder of rupees 40,000. Then we have second step, that will be calculation of expected rate of dividend. So profit available for equity shareholders needs to divide total paid up minus, sorry, profit available for equity shareholders, that will be divided from total paid up equity share capital multiplied by 100. So our profits available for equity shareholders is rupees 40,000, and the total paid up equity share capital is rupees 1,60,000 multiplied by 100 is equal to 25,000. So we have step 3, calculation of value of equity share. So value of equity share is equal to expected rate divided by normal rate multiplied by paid up value per share. So expected rate is 25, normal rate is 15, and the paid up value per share is 8. So we have the value of 13.33. Again, we have an illustration. The paid up share capital of the company consists of 4,000 5% preference share of rupees 10 each and 8,000 equity share of rupees 100 each. In addition to the fixed dividend of 5%, the preference shareholder are also entitled to participate in the profit up to 4% after payment of dividend of 10% on the equity shares. So any surplus of profit was available for the company shareholder, the annual average profit of the company are rupees 2 lakh. After providing for depreciation and taxes, it is considered necessary to transfer rupees 12,000 per annum to reserve fund. The normal return expected on preference share is 10%, and that on equity share is 12%. So you need to calculate the value of each preference shares and equity share in the company. So first of all, we need to have the average annual profit, rupees 2 lakh. Then we deduct transfer to reserve 12,000, and we get the divisible profit of rupees 1,88,000. Then we deduct preference dividend at 5%. So we need to deduct the preference dividend at rupees 5% of 4 lakh, that will be 20,000, and we get 1,68,000. Then we need to deduct equity dividend of 10% on rupees 8 lakh, that will be 80,000. So the remaining profit available for shareholder will be 88,000. So after that, we need to deduct 4% on rupees 4 lakh for preference shareholder, that will be 16,000. Surplus available for equity shareholders 72,000. So in the step 1, calculation of expected rate of dividend on preference share. So the expected rate of dividend will be profit for preference shareholders divided preference share capital multiplied by 100. So 20,000 need to add 16,000 divided by 4 lakh is equal to 100. Sorry, multiplied by 100 is equal to 9%. In the step 2, we will have calculation of expected rate of dividend on equity shares. So expected rate of dividend, that will be profit for equity shareholders. Then we divide equity share capital multiplied by 100. So 80,000 plus 72,000 divided by 8 lakh multiplied by 100 is equal to 19%. Third one is calculation of value of share. So value of preference share is equal to expected rate divided by normal rate multiplied by paid up value per share. So the value of preference share, that will be 9 divided by 10 multiplied by 100 is equal to 90. Next one is value of equity share is equal to expected rate divided by normal rate multiplied by paid up value per share. Then the value of preference share is equal to 19 divided by 12 multiplied by 100 is equal to 158.33. Next one is earning capacity method. So this method of valuation of share is particularly suitable in the case of big investor because they are more interested in the company's earning rather than what the company distributes in the form of dividend. This method covers up some of limitation of the yield method. This method assumes that the company will continue to operate its business in the near future. Hence, in this method, the rate of earning are compared with the normal rate of return which is prevailing in the industry. So, formula for this method will be value of share is equal to rate of funding divided by normal rate of return multiplied by paid up value per share. So the two elements which are required for this method, first one is rate of funding. Rate of funding will be the profit earned or estimated future earnings are compared with the net capital employed in the business gives the rate of funding. So the formula will be the rate of funding is equal to estimated future earning divided by capital employed multiplied by 100. Further, there are two elements are required for the calculation of rate of funding. First one is estimated future earning. For calculating the estimated future earnings, some adjustments are required to be made in the profit. These adjustments are, first one is the abnormal losses, if any adjusted from the profit, should be added back to the profits. Second one is the abnormal profit should be deducted from the profit for a particular year in which they included. Third one is any other adjustment which affect the past profit should be adjusted. Next one is any income from the investment must be excluded from the profit. So if the profit of the previous year are showing the increasing trend, then the weighted average method should be used for calculating the average profit. Then there is a future maintainable profit that should be calculated after considering the following factors. First one is change in the taste of the customer. Second one is change in the management of the company. Third one is change in the business structure. Fourth one is change in the government policy. So after computing the average profit as all above, tax is deducted according to the latest tax provision and the interest on debenture is then added back to the profits. Then the capital employed is calculated by taking the asset at the market value and then deducting the current liability from the total of assets. So here are some following points which are considered while calculating the value of capital employed. First one is the amount of debentures or preference shares is not deducted from the total of assets. Second one is goodwill is included in the asset. Third one is investment outside the business are not included in the value of asset. Similarly, interest on investment is not included in the profit while calculating estimated earning. Second one is normal rate. Normal rate of earning or return is normally given in the question. So the rate is different industry. So here we have an illustration in which we have equity and liabilities and assets. We have some additional information that the market value of half of the asset is 20% higher. The company earns the profit of rupees 3,66,000 per annum after interest on debenture, but before tax. 12% is the normal rate of return in such companies. Assume income tax rate at 50%. Calculate value of share of the company with earning capacity method. So first of all, we need to calculate calculation of profit earned. So first one is annual profit, that will be 3,66,000. Then we deduct income tax at 50%, that will be 1,83,000. Then we have profit after tax, that will be 1,83,000. Then we add interest on debenture 10% on rupees 1,50,000, that will be 15,000. Then we have profit after tax before interest 1,98,000. Step 2 is calculation of capital employed. So first of all, we have asset as per balance sheet 10 lakh. Then we add increase in market value 20% of rupees 5 lakh, 1 lakh. After that, we have the gross capital employed of rupees 11 lakh. Then we deduct the current liability of rupees 1 lakh 10,000. Then net capital employed 9 lakh 90,000. Then we have step 3 of rate of earning. Rate of earning is equal to profit earned divided by net capital employed multiplied by 100. So the profit earned is 1,98,000 and the net capital employed is 9,90,000 multiplied by 100 is equal to 20%. Calculation of value of shares, we have rate of earning divided by normal rate of return multiplied by paid up value of share. So 20 is the rate of funding. Then we divide it from normal rate of return, that will be 12, and the paid up value of share, that is rupees 10. So we have the value of rupees 16.67 per share. Again, we have another illustration in which we have the whole balance sheet and additional information that all the assets are worth their book value except fixed asset, which on recent valuation are worth rupees 19 lakh 20,000. Profit after tax for the last 3 years rupees 6 lakh, rupees 5 lakh 20,000 and 6 lakh 20,000 respectively. The published market price of a share of a company doing similar business is 4 times its paid up value on the basis of 36% dividend. Find out the value of share on the basis of net capital employed. So step 1 is calculation of average profit. So average profit is equal to 6 lakh plus 5 lakh 20,000 plus 6 lakh 20,000 divided by 3. So the average profit will be 5 lakh 80,000. Step 2 is to calculate the profit earned. For that, first of all, we will take the annual profit of rupees 5 lakh 80,000. Then we deduct the income tax from it. That is nil in this question. Then we have profit after tax, same as the value 5 lakh 80,000. Then we need to add the interest on debenture. It is also nil in this question. Then we have the profit after tax before interest is 5 lakh 80,000. Then we have calculation of capital employed. So the calculation of capital employed will be fixed asset 19 lakh 20,000, stock 9 lakh 20,000, debtors 3 lakh 60,000, cash 1 lakh 60,000. Then we deduct creditors from it 1 lakh. provident fund 1,20,000, employee saving fund 80,000, less provision for taxation 1,60,000. Then we have the net capital employed 29 lakh. In the step 4, we have calculation of rate of funding. Rate of funding is equal to profit earned divided by net capital employed. So profit earned will be rupees 5,80,000 and net capital employed will be 29 lakh, which will be multiplied by 100. So the rate of funding is 20%. In the step 5, we have calculation of normal rate. For 36% dividend, value of share is 4 times. So the normal rate of return is 36% divided by 4 is equal to 9%. In the step 6, calculation of value of share. Value of share is equal to rate of earning divided by normal rate of return multiplied by paid up value of shares. So the value of share is equal to 20 divided by 9 multiplied by 20 is equal to 44.44 per share. Next one is fair value method. So there is much difference in the value of the same share in case it is calculated under different method. So none of the method give the true and fair view of the value of share. So it is considered appropriate by the experts to calculate the value under any two methods and then averaging the both. So calculated average value can be taken as the fair value of the share. So the formula for the calculation of the fair value of the share is fair value per share is equal to value as per net asset method. Then we add value as per earning capacity method and we divide it from 2. Then we have a fair value per share is equal to value as per net asset method. Then we add value as per dividend yield method. Then we divide it from it 2. We have an illustration, we have a balance sheet, then we have some additional information that the assets are revalued as follows. Goodwill was valued at rupees 50,000. Other fixed assets were 20,000 above their book values. Stock and debtors valued 10% below their book values. Profit after interest but before tax rupees 3,47,200. Tax rate 50%. Normal rate of return 16%. Calculate the fair value of share of the company. So for this question, we need to calculate calculation of value of share by net asset method. Step 1 is calculation of net asset. Net asset is equal to realizable value of asset. Then we deduct the outside liability. For this, we have goodwill of rupees 50,000, land and building 2 lakh plus 20%, 2 lakh 40,000, plant and machinery 2 lakh plus 20,000. It also costs 2 lakh 40,000. Furniture 40,000, then we add 20%, that will be 48,000. Investment 1 lakh, then we deduct 25,000, we have 75,000. Stock 2 lakh 20,000, deduct 10%, 1 lakh 98,000. Debtors 80,000, deduct 10%, 72,000. Cash 70,000. Then we deduct 8% debentures of rupees 1 lakh, deduct creditors 35,000, net asset 8 lakh 58,000. Our second step is calculation of value of share. So value of share is equal to net asset divided by number of equity shares. So 8 lakh 58,000 divided by 4,000 is equal to rupees 214.50. Then we have the calculation of value of share by earning capacity method. So the calculation of profit earned. So profit after interest before tax 3,47,200. Then we deduct income from investment 10,000. 3,37,200 we get. Then we deduct income tax 50%, 1,68,600, and we get the profit after tax. Then we add interest on debenture 8,000. We get profit after tax before interest 1,76,600. Our step 2 is calculation of capital employed. Goodwill 50,000. Exact the same process which we do earlier. Then from it we will deduct the creditors and we get the capital employed 8 lakh 83,000. In the step 3 we need to calculate the rate of funding. So rate of funding is equal to profit earned divided by net capital employed multiplied by 100. So profit earned will be 1,76,600, and then we divided from 8 lakh 83,000 and multiplied by 100 is equal to 20%. Then we have the step 4, calculation of value of share. So value of share is equal to rate of earning divided by normal rate of return multiplied by paid up value of share. So the value of share is equal to 20 divided by 16 multiplied by 200. So the value per share is equal to rupees 250. Then the calculation of fair value per share. Fair value per share is equal to value as per net asset method plus value as per earning capacity method. So fair value method per share, value as per net asset method, that will be 214.5, and the value as per earning capacity method, that will be 250. We add both and divided by 2, so we will get the fair value per share, that will be 2,32,000.25. Sorry, rupees 232.25. Another, we have the illustration which you can do at your home. We have the additional information. Then we have the step 1, calculation of net asset. In this way, you can check this out. In the step 2, you will calculate the calculation of value of share, in which you use the formula of value of share is equal to net asset divided by number of equity shares. So in the case, you need to calculate the value of share by earning capacity method. Step 1, calculation of profit earned. Step next step is to calculate the net capital employed. Step 2. Then step 3 is calculation of rate of earning, in which you use the formula is profit earned divided by net capital employed multiplied by 100. Then in the step 4, you need to calculate the value of share is equal to rate of earning divided by normal rate of return multiplied by paid up value of share. Then you will calculate the fair value per share. So the value per as per net asset method, added value as per earning capacity method. So 26.60 plus 11.18 divided by 2 is equal to 18.89. So this is our basically 12th unit of block 3, and block 3 is completed. So we will discuss our next unit, that will be unit 13, but it's from block 4. So block 4, unit 13, topic is amalgamation of companies and its basic concepts. So in the case of amalgamation of companies, first of all, we need to know the objective and introduction. And what is the objective of amalgamation? Reconstruction. Reconstruction consists of two types, external, internal. Then what is the difference between amalgamation, absorption and reconstruction? Then some important terms in amalgamation. Methods of accounting for amalgamation, treatment of reserve on amalgamation, treatment of goodwill arising on amalgamation. So, we will analyze about the methods of accounting for amalgamation, treatment of reserve on amalgamation, treatment of goodwill arising on amalgamation, then what is purchase consideration. So, in the objective, first of all, we need to understand the concept of amalgamation, state of objectives of amalgamation, then identify the difference between external and internal reconstruction. Then we need to describe the methods of amalgamation, explain the treatment of reserve and goodwill on amalgamation, and determine the amount of purchase consideration on amalgamation. So, in the introduction, basically, when basically to reduce the cutthroat competition between two or more than two joint stock companies, they may combine their undertaking and become one joint stock company. So it can be done either by one of the existing joint stock companies taking over the other combining company or companies, later being dissolved, or by standing a new joint stock company which takes over all the combining joint stock companies. It is being done either by amalgamation or absorption. So first of all, we need to know the meaning of amalgamation. When two or more companies, same in all respect, go into liquidation and the new company is formed to take over their business, that will be known as the amalgamation. So, for example, if a new company C Limited is formed to take over A Limited and B Limited, which are existing company, it is an example of amalgamation. Next one, which we need to understand, is absorption. So, under absorption, no new company is formed, whereas an existing company purchases another existing company. It is called absorption. Next one is objectives of amalgamation. Amalgamation means merging of two or more than two companies for eliminating competition among them or for growing in size to achieve the economies of scale. Then amalgamation is a broad term which includes mergers, that is uniting of two existing companies, and acquisition. One company buying out another company. There are many objectives of amalgamation. Some of the objectives are as follows, like to have a better control over the market and also to increase the market share and area of operations. Second one is to eliminate the cutthroat competition and rivalry among competition, the amalgamating companies. Third one is to enjoy the economies of large scale production. Fourth one is to utilize the services of professional experts. Fifth one is to increase the availability of funds for the future investment plans. Next one is to achieve all the advantages of combination. Next one is reconstruction. Basically, reconstruction is entirely of different nature. The objective is not to bring about a combination of companies, but merely to recognize a company which has suffered huge losses, which are to be written off. Reconstruction may be of two types. External reconstruction, it may not exactly similar to amalgamation. In external reconstruction, existing company is wound up by selling its business to newly formed company which is generally similar, named or owned by the same shareholder. Next one is internal reconstruction. It is altogether a different form of business combination. In internal reconstruction, the company continues its legal entity and is only internally reorganized. In this rearrangement and reduction of share capital is done. Under internal reconstruction, the share capital is reduced to its real worth and the same amount is used to eliminate the accumulated losses, fictitious assets, and write down the overvalued asset of the company. Then, what is the difference between amalgamation, absorption, and reconstruction? Here we have a difference. First one is of formation. Amalgamation, form a new company. Absorption, no new company. Reconstruction, company is reconstructed. In the liquidation, second basis is all the companies which go for amalgamation are liquidated. The companies whose business is purchased by another company goes into liquidation, and the company which is reconstructed goes into liquidation. Third one is financial position and financial position of the company. Financial position of all the involved companies is same. Financial position of the absorbing company is comparatively sound than the absorbed company. Financial position of the old company is bad and is usually considered as the sick unit. Then objective, to eliminate the competition among the amalgamated company. Next, to expand the business and to achieve the economies of large scale production. Next is to write off the accumulated losses and offering the real worth of the business to the shareholder. Next is position of shareholder in new company. Shareholders of the amalgamated companies become the shareholder of the new company. Shareholder of the selling company may become the shareholder of the purchasing company. Most of the shareholder of the old company continue to be the shareholder of the new company with the proportionate share. Next, here are some important terms in amalgamation. Like first one is transferor company. So this means the company which is amalgamated into another company. Transferee company. It is company in which transferor company amalgamate. Third one is amalgamation. It has basically two types. First one is nature of merger. Nature of merger states that all the assets and liabilities of the transferor company become after amalgamation the asset and liabilities of the transferee company. Second one is shareholder holding not less than 90% of the face value of the equity share of the transferor company. Third one is the consideration of the amalgamation receivable by those equity shareholders of the transferor company who agree to become equity shareholder of the transferee company is discharged by the transferee company wholly by the issue of equity share to the transferee company, with the exception that cash may be paid only in respect of fractional shares. Next one is the amalgamation. The business of the transferor company is intended to be carried on after the amalgamation by the transferee company. Next one is no adjustment is intended to be made to the book value of the shares and liabilities of the transferor company when they are incorporated in the financial statement of the transferee company, except to ensure uniformity of the accounting policies. Next one is amalgamation in the nature of purchase. Then, in that case, basically, amalgamation which does not satisfy any one or more of the five conditions stated above. Next one is asset purchase and business purchase. If it is mentioned in the question that the transferee company has purchased the asset of the transferor company, it means that the transferee company has acquired all the assets, including cash, and not the liabilities of the business of the transferor company. If it is mentioned that the transferee company has purchased the business of the transferor company, it means that transferee company has acquired all the asset and liabilities of the transferor company. Next one is liability and trade liability. The term liability includes trade creditors, bill payable, debentures, bank overdraft, outstanding expenses, pension funds, provident funds, workmen profit sharing funds, etc. The term trade liability includes creditors and bills payable which are associated with sale, purchase of goods and services. Then methods of accounting for amalgamation. There are two methods. First one is pulling of interest method and the second one is purchase method. So first one is the pulling of interest method. So under the pulling of interest method, the asset, liabilities, reserve of the transferor company are recorded by the transferee company at their existing carrying amounts. So basically, the effect of the financial statement of any changes in accounting policy are reported in accordance with accounting standard, that is AS5. Then net profit or loss for the period, prior period items and the changes in accounting policy. Then the purchase method. Under the purchase method, the transferee company account for the amalgamation either by incorporating the asset and liabilities at their existing carrying amounts or by allocating the consideration to individual identifiable asset and liabilities of the transferor company or the basis of their fair value at the date of amalgamation. The identifiable asset and liabilities may include asset and liability not recorded in the financial statement of the transferor company. When asset and liabilities are restated on the basis of their fair values, the determination fair values may be influenced by the intention of the transferee company. Next one is treatment of reserve on amalgamation. Basically, if the amalgamation is an amalgamation in the nature of merger, the identity of the reserve is preserved and they appear in the financial statement of the transferee company in the same form in which they appeared in the financial statement of the transferee company. So, if the amalgamation in the nature of purchase, the identity of the reserve other than the statutory reserve, that will be dealt above and is not preserved. So, the amount of the consideration is deducted from the value of the net asset of the transferor company acquired by the transferor company. Next one is treatment of goodwill arising on amalgamation. So the goodwill which is arising on amalgamation, that will be represent a payment made in anticipating of future income, and it is appropriate to treat it as a asset to be amortized to income on a systematic basis over its useful life. Due to the nature of goodwill, it is frequently difficult to estimate its useful life with reasonable uncertainty. Next one is balance of P&L account. So in the case of amalgamation in the nature of merger, the balance of P&L account appearing in the financial statement of the transferor company is aggregated with the corresponding balance appearing in the financial statement of the transferee company. Then alternatively, it is transferred to the general reserve if there is any. In the case of an amalgamation in the nature of purchase, the balance of the P&L account appearing in the financial statement, the transferee company, whether debit or credit, loses its identity. Next one is purchase consideration. There are different methods for it. First one is lump sum method. When whole the amount given in one go, that will be known as lump sum method. Next one is net asset method. When valuation is done through the all the assets, then it will be known as the net asset method. Net payment method is the method which is calculating by adding the various payments in the form of share, security, cash made by the transferee company, and no amount of liability is deducted even if these are assumed by the purchasing company. Next one is intrinsic worth value method. This is the method is just an extension of the net asset method. So the purchase consideration method is required to be calculated on the basis of intrinsic value of share. So the intrinsic value of a share is calculated by dividing the net asset available for equity shareholders by the number of equity share. This value determines the ratio of exchange of shares between the transferor and the transferee company. So this is our 13th unit of block 4, and we have two more units in block 4, and then we have block 5, which we need to cover in the next two sessions. So I hope you will basically check all the things, and then you may ask any query from me in the next session. Or just a second. In this particular unit, we have a numerical also, like this. You will get the numerical that, for example, X Limited agrees to give for rupees 10 shares of Y Limited, 15 shares of 10 each, 8 paid up. Then X Limited agrees to pay rupees 15,000 cash to discharge the creditor. So the purchase consideration is calculated as follows. So the shareholders of Y Limited will get 6,000 multiplied by 15 divided by 10 is equal to 9,000 shares of rupees 10 each at the rate of 8 paid up, that will be 72,000. Then cash paid 15,000. So the purchase consideration total is 87,000. So this kind of questions you can solve at your home. So we end up our session here. Please read these two units, one from block 3 and one from block 4. And we already basically we already covered 3 blocks totally. That means we covered block 1. It also contains 3 units. Block 2 contains 3 units, and block 3 contains 3 units. And in the block 4 first unit we already finished. That will be 3 plus 3 plus 3, 9, 10 units, 13 units we have done basically. So please make sure you will practice your illustrations correctly at your home, because in the question paper you will get the numericals also. Thank you so much for today. So we will end up our class.